Okay, everyone, welcome to our second advanced training class. We did our first one in May, and it went over very well. And we had a lot of requests to do another one, so here we are. I wanted to spend just a minute and kind of explain what our intent is for this advanced training. Our goal here is to get beyond what we teach in the basic training with Best Choice. We assume that everyone that attends the advanced training has already worked with a coach, either one-on-one or in one of our basic training classes, and so we really don't cover a lot of the basics because that's a different class. But our goal for these advanced trainings is to add to what we've already taught you in terms of how to use Best Choice. And so some of the things that we go over are maybe more advanced uses or advanced ways to use Best Choice. And what we're going to cover today is going to be once you've picked a trade from Best Choice, once you have a watch list that you're looking to get in a trade, how to maximize your profits by timing your entries, your exits, and managing the trade. And by managing the trade, I mean, should I stay in the trade if I've got profit? Should I go ahead and take my profit and get out? So we're going to be showing you a couple of things that I think are real important factors once you've determined which stocks you're going to watch based on seasonality and running the Cycle Wizard and Best Choice. How can I optimize getting into those trades? How can I optimize my strike price, my risk reward, and so forth? I'm going to be covering volatility, and I'm probably going to take my full hour and a half and not even cover 10% of what is available knowledge-wise for volatility. Volatility can be a very complex thing to understand, and there are lots of different ways to use it. I'm going to stick to the basics of volatility today, and even the basics, hopefully it's not too complex as an introduction to volatility. Gary, among other things, mostly is going to be covering Fibonacci numbers because Fibonacci retracement numbers can be very helpful in knowing how long to stay into a trade, when to get out of a trade, and he's going to cover a couple of other technical indicators that can help you time your exits and knowing when to hang on and possibly make a little more profit. So those are the main topics. I need to go through, I guess, the next slide is our risk disclosure. Let me just cover this real quick. This is just a basic FINRA. The main points here is the information that we're going to present today does not constitute trading or other advice regarding the purchase or sale of any futures, options, securities, or other financial products. Basically, that means, guys, we're not brokers, we're not licensed, we're not telling you what stocks to trade. Any stocks that we use as examples today, we've only picked because they're examples of the concept that we want to teach you. They are by no means trades that we're looking at right now or so forth. I may have some trades that I got in and got out already, but we're not brokers is the basic thing. And so absolutely do not write down any stock symbols today because that is not what we're here to do. We're here to teach you how to do your own trading. The other thing in here, the information and course materials that we provide are for education only. And the main point, futures and options trading involves risk. But if you trade in the market, you probably already know that. Okay, I'm just going to launch into it because I'm afraid I may go overtime on this. All right, let me start with just a general definition. Well, let me kind of give you an outline first of what I'm going to cover today. First of all, What is volatility? Why is it important to your trading decisions? How does volatility work? And finally, I'm going to go through some examples of how you can use volatility to make better trading decisions. All right, the first question, what is volatility? Volatility is a measure of the range of price movement over a period of time. In other words, if I'm looking at the past 10 days, 20 days, 3 months, 6 months, what's the range of price movement up and down that a particular stock has traveled? That is the basic definition of volatility. A wide range of price movement will result in a high volatility. And vice versa, a small range of price movement results in low volatility. And let me show you an example of what that looks like. All right, I picked 2 stocks here before we got started, and the only reason I picked these were for an example of volatility. These are not stocks that I'm looking to trade or anything like that. This is FLS, Flowserve Corp. You see it right up here. This is an example of wide volatility, and this is one of the great things that Pete built into Best Choice is a visual way to look at the range or the width of the volatility. You can see these 3 lines, the outer lines are spread far apart. I've got another one here, VRX, Valeant Pharmaceutica. Apologize for the slow computer, guys. And you see that on this chart, the outer lines are very close together. This would be a low volatility stock. So we have a low volatility, high volatility. Now that's just a very simple representation of what volatility is. It's over a period of time. I've got a 6-month chart, and we see that this particular stock in the past 6 months has ranged from about $82 to up almost to $102 between the 2 outer lines. That's a wide range of volatility. So this particular stock would probably currently be at a high volatility rate. All right, second question. Why is volatility important? Well, I think that volatility is the most critical factor in determining the option premium price. And that's going to be what I'm going to get into next. Volatility is a major, probably the major factor in determining how the premium at different strike levels is priced. As volatility fluctuates, so does the premium pricing. And as I'm going to show you, volatility is the only factor that determines whether an option is cheap or expensive. Now, when I say cheap or expensive, if you think about the 3-line chart and what Pete and your coaches have taught you when analyzing that 3-line chart, you know that if the stock price is near that lower band, we say that that stock is currently relatively cheap. And if the stock price is at the upper band, that stock price is currently relatively expensive. Well, the same thing applies to options at the different strike levels. You can have a 1 strike out, and that particular strike can actually be overpriced relative to how it normally trades in the market. And you can go 1 or 2 strikes further out, and possibly those strikes are priced closer to what the market conditions should be. Now, currently, we don't have any visual chart in Best Choice that is able to show you whether an option price is cheap or expensive. We're working on building that into the version 5.0. Pete has done a lot of work on building some visual charts, because that's the power of Best Choice, is putting these technical indicators and information into visual format. And they're working on putting that into version 5.0. So since we don't have that built into Best Choice yet, what I'm going to go through today is going to help you be able to determine, is that strike price that I'm looking at right now, is that cheap or expensive? Am I going to pay too much for that particular strike price? So how does this all work? Well, there's different factors that go into an options premium price. There are mostly fundamental factors, and by fundamental I mean factors that everyone knows. And then there are emotional factors. And let me start with fair market value. Fair market value is comprised of, and this is fair market value for an option premium, okay? Fair market value is made up of the underlying stock price, the strike price that you're looking at, the expiration date or the time value, the current interest rate, and finally the historical volatility. Now, this is the first time I've mentioned anything other than just plain volatility. There are basically two types of volatility. There's historical and there's implied. Now, all of these factors that go into the fair market value of the option, these are all known quantities. These are all things that everyone involved in the transaction, the buyer and the seller and the market makers, they all know what these are. We know what the current stock price is. We know what the current strike price we're looking at. We know whether we're looking at a September or an October or a December expiration date. We know what the current interest rates are. And we know what the historical volatility is, because the historical volatility is looking backwards over time. When we looked at that 6-month chart that I just showed you between the two, the high volatile stock and the low volatile stock, that's looking back over time. And we can determine what is the range of volatility over the past 6 months. So all these 5 factors are known quantities. Well, if this were the only way that option premiums got priced, then the option premium would always be the same based on these 5 factors, because all of these are actually known factors. Here's the difference between historical volatility and implied volatility. Historical volatility is a measure of the volatility of the underlying stock or futures contract. It is a known volatility. It's a known factor, because it's based on actual recent price changes of the underlying. On the other hand, the other type of volatility is implied volatility. Implied volatility is the future prediction of volatility. It's not a known factor of the past, but the market's guess of the future. So if we're pricing an option, let me back up one slide here. If the premium price that you look to pay when you're getting into a position were only based on all these known factors, then that price, there would be no fluctuation in the price. But implied volatility affects that price. And what is implied volatility? It's the future prediction of the volatility. It's not a known quantity. It's a guess. And I've got a little example here. Let's say that let's say I'm looking to buy a used car. And find this car on the internet and you're selling this car. Nice 69 Pontiac GTO. It's all restored in really good shape. Well, there's two people involved in this transaction. There's a buyer, that's me, and there's a seller, and that's you. You've got the car and you want to sell it, and I'm looking to buy a car. Well, there's certain things that we already know, that we both know about this car. We know model and make. It's a 69 Pontiac GTO. We know that it's in good running condition. We know that it's drivable. So there are certain fundamental factors that we both can agree on. But there's another factor that we don't particularly agree on, and that's the emotional factor. Now, I may be looking for a used car because I just need to get to work. I just need some transportation. I really don't care if it's a Ferrari or a Yugo. Okay, I just want something that runs. So my emotional factor in this transaction is pretty low. I just want basic transportation. But you as the seller, you have a different emotional factor. This may be a car that you spent the last 5 years restoring it in every detail. This may be the same car you drove when you were 16 years old. You're going to have a high emotional factor in selling this car. Well, if we only based the price of the car on the fundamentals, yeah, it's a car, it's got 4 wheels, it runs, it'll get me to work, then there would be no disagreement on the price. But where the negotiation comes in on the price is, I just need transportation, but you're in love with this car. So you're going to want a premium price. I'm not willing to pay a premium price. And that's where the negotiation starts to come to the final price point. And it works the same way in options, and that's that emotional component. You're in love with it. I really don't care. That emotional component is implied volatility. Now, if we flip this around, let's say I'm looking for a car. I'm still the buyer. I find this car on the internet. Now, this car is the car I drove when I was 16 years old. And I am a classic car collector. I just love cars. Now, you're still the seller, and you've got this car for sale. How did you get this car? Well, you inherited this car from your great-great-great-great-great-uncle who just passed away. And you really don't want this car. It's taking up space in your driveway. You have no room to park it, and you just want to get rid of it. Again, it's the same car, same 4 wheels, same condition. The fundamentals are all the same, but now the emotional component is switched. I really want to buy this car, and you really just want to get rid of it. So do you see how that emotional component changes or sways the final price of whatever we're looking at? That is implied volatility. All right, there are basically, as I just said, 2 components of pricing. There is the rational information or the fundamentals, and then there's the emotional information. Implied volatility is the emotional component in the option price, and that's why option pricing fluctuates. Because again, if it was only based on that fundamental information that both the buyer and seller already know, we know the stock, we know the strike price, we know that fundamental information. If it were only based on those factors, the option premium would not change unless one of those fundamentals changed. But all those fundamentals can remain the same. The stock's the same. The stock can be trading at the same price, but that option premium can be different from one day to the next. That is an effect of implied volatility. All right. I think I covered this slide already. Oh, no, this is, okay, before I was talking about the fair market value. fair market value consisted of the same fundamentals, stock price, strike price, expiration date, interest rate, but the actual market price that you see, the price that fluctuates day to day and even throughout the day, is different than the fair market value only due to implied volatility. That's the only factor in pricing an option premium that changes. What's that future expectation of volatility? If the future expectation, if the market's getting nervous and they're not sure that stock may start moving in a wide range of price movement in the future, that implied volatility is going to go up. And when that implied volatility, that future fear, if you will, you've heard that the VIX is the fear index. That when that future fear goes up, that's going to drive up the price of the premium over the fair market value, which is based on the historical volatility, which we already know. So the only factor between what the premium, the strike price, should be priced at and where it's actually priced at, the only variable is the implied volatility. This is why implied volatility is so important when you're getting into trades. You have got to look and see, is that implied volatility close to what the historical is? In other words, is the actual price I'm looking to pay for this particular strike close to what the market should be at this point? And if it's not close, that difference is in the implied volatility. So it's a critical factor to look at when you're picking a trade. You can't just look at how many strikes should I go out or what's the delta. Those are all important factors, but if you don't pay attention to what the market is forecasting, you can get killed. What this does, it allows us to determine, is an option price cheap or expensive? We know the stock, we know the strike price, the expiration date, and the interest rate. Implied volatility is the only difference between what an option should be worth and what it's actually selling for right now. Okay, how do we use this information? How do I determine if the implied volatility is going to affect my trade or not? Well, the first thing that we have to establish is that volatility is relative. In other words, it's relative to the stock. Different stocks will have different levels of implied volatility. One stock may be at an implied volatility of 60. Another stock may be at an implied volatility of 40, but actually the stock that's at 40 might be too expensive. That might be high for that particular stock. So you can't really compare one stock to another in terms of the implied volatility. You've got to look at what's the relative average volatility of that particular stock, and I'm going to show you how to do that in a minute. Volatility is also relative to the expiration date. Typically, a short expiration date can possibly have a higher volatility than an expiration 2 or 3 months down the road. Why is that? Well, if you think of the seller of that option, if you're on the selling end and you've got 2 or 3 months, then you've got plenty of time to see what the actual volatility is going to be before you get close to that expiration. But if you're selling an option that expires in a week and a half, you don't have much time. Now, there is kind of an inverse relationship here. Further out expiration dates will have more sensitivity to volatility than the close in, which means the movement on the stock will be exaggerated more for a 2-month, 3-month option than a close in, but the actual volatility will usually be higher on the close month than it is on the outer months. Volatility is also relative to the strike price. The further away you get from at the money, either going in the money or out of the money, the further away you get from that at the money, the higher the volatility is going to be. And I'm not going to get into it because I'm trying to stick to the basics, but that's basically called volatility smile. You can do some research on your own after today and go more in-depth into volatility if you want to. I just didn't feel like I was going to have time to get too technical today. I wanted to just get the basics in front of you. But the strike price can affect the level of volatility also. Now, when we're talking about the difference in volatility over different expiration dates, that's called horizontal volatility. When we're talking about the difference in volatility between strike prices in the same month, that's vertical volatility. And I'm not going to go into explanation of those, just wanted to give you those definitions. And the last thing is volatility is also relative to the side of the trade that you're on, whether it's a call or a put. And there's usually not a lot of difference between the implied volatility at a particular strike level on the call or the put, but you will see a difference in the volatility. Well, so how can I use this information when I'm getting ready to get into a trade? How can I find out, is this overpriced? Is it expensive or cheap? What's the normal implied volatility for this particular stock, for this expiration date, for this strike price, so forth? Well, there's several different sources that you can pull up volatility charts. And so there's, not any one place that's better than the other. I particularly use iVolatility, and I'll show you in a minute how to get to it and pull up these charts. But here's a volatility chart on NetApp. That's the stock I'm going to be using as an example today. This is a one-year chart on volatility. And you can see our two lines here. The gold line is the mean. Basically, this is your implied volatility, IV mean, your average implied volatility. The blue line is a 30-day average, a 30-day moving average of the historical volatility. HV is historical volatility. IV is implied volatility. Now let's go back to our definitions. What's historical volatility? This was the actual range of price movement up and down over time. What's the implied volatility? That's the market's guess at future up and down price movement. And so when we overlay the historical with the implied, we can start to see a relationship here. Now, typically the implied volatility normally will move before the historical, obviously, because the implied volatility is anticipating the future, and then the historical is showing the past. So if we look at a couple of different sections here, I don't know if you can see my arrow, but you see this drop in implied volatility right here in November. Not quite a month later, it was followed by a drop in the historical volatility. Here's the future prediction. Here's what actually happened. Well, that's great, Stan. I see that they mirror each other, but how do I use this information? Well, here's what you need to look at when you're ready to get into a trade. You need to check and see if the option and the strike that you're looking at is cheap or expensive based on this volatility. So what we want to look at is over the course of a year, where has the overall volatility been for the most part? And it looks like it's hung around pretty much this 40% level. Okay? I don't have an average. If I could put an average, line straight across here, it would give me a more accurate average over the course of a year, but I'm going to guess that it's somewhere around maybe just a little bit under the 40% line here. So if I'm looking to get into this trade and I see that the current implied volatility is at 65, that's going to tell me that currently that particular strike price is expensive relative to how this stock normally moves in terms of volatility of price movement. And conversely, if I look at the current implied volatility and it's at 32, then I know that currently that strike price is relatively cheap. That would be a good time to buy a call or buy a put. Typically when volatility is high, that is a selling opportunity, and any of you who use more than just directional trading strategies, if you're doing spreads or maybe you like to sell calls and puts and collect premium, you want to sell when volatility is high, and you want to buy when volatility is low. So if you're like me and you're just sort of an average simple trader, I just like to buy calls and buy puts. Best Choice tells me when to look for those things to move 10 out of 10 years. I just want to buy a call if it's going to go up, buy a put if it's going to go down. So I want to get in position when volatility is relatively low. And you can see here currently that the volatility is pretty much back to its almost average level. Now, right in this area, May and June, I would not have wanted to be buying at that time. If that's all I'm doing is buying a call or buying a put, this would have been a risky time to be buying. Right here is where I would really like to buy. You see, this started up and almost immediately the historical volatility. This is going to drive up the price of your option. This is going to add to the money, the profit that you can make. Now let's zoom in a little closer. Here's a 3-month chart on the same stock. And here's my current level of volatility. Here's the implied and here's the historical. And you can see the historical volatility is still a little bit above its average, but the implied is really coming down. Now this gives me two indications to think about in looking at getting into this trade. First of all, when does historical move compared to implied? It moves afterwards. If the implied is already going down, we can expect that the volatility, the range of price movement on this stock, will probably be slowing down in the near future. So if we're expecting a big move, and I'm not talking about based on earnings report or anything, this is just, during the year, 10 out of 10 it goes up. If we're expecting a big move, we may not get it in the next few weeks because this historical will start to come down to follow this implied. Now the other factor that I look at here is a good time to get in is when the implied is lower than the historical, especially if you see that the implied is starting to turn up, because then we're going to get in ahead of increased actual volatility or historical volatility. Guys, I hope this is not too confusing, because in putting this together, believe me, my brain was getting twisted in knots. I tried to keep this as simple and step-by-step as possible. But the basic idea here is you want to try and avoid trades if you can, or at least particular strike prices when the volatility is very high. Because what happens is, and I'm sure this has happened to pretty much everyone that's been here, the stock can actually move in your direction and your option doesn't increase in value or may even lose value. And you're left sitting there wondering, wait a minute, the stock moved up $5 and I lost money. How'd that happen? It's all due to the implied volatility. Because implied volatility goes into the true market value of that option premium. And if the implied volatility drops, that premium price is going to drop even if the stock is going up. If the volatility drops faster than the premium price is moving up, then you can actually lose money. Now I'm going to show you, let's see, let's go to, I'll tell you what, let's go to some examples here. Well, no, let me explain what Vega is. Before I go to some option chains and kind of show you how this effect looks, what this effect looks like in the option chain and how it affects pricing, I need to explain what Vega is. Vega is one of the Greeks, you know, delta, theta, Vega. Everybody pretty much knows what delta is. Delta is a measure of how much your option price will change based on the stock price movement. In other words, if you've got a 0.5 delta or a 50-cent delta, you know for every dollar that the stock moves, your option is going to move 50 cents, either direction. Well, Vega is the same thing in terms of affecting the price of your option, but Vega is a measure of the option price sensitivity to implied volatility. Now, I was trying to explain this to Gary the other day, and it took me 2 or 3 times, so let me go through that again and make sure you've got that. Vega is the measure of option price sensitivity to implied volatility. So as implied volatility moves, your Vega tells you how much your option price is going to change for every 1 point movement on the implied volatility. Just as delta tells you how much your option price is going to change for every $1 move on the stock. Okay, it works the same way, but they're each measuring something different. Vega is measuring the price movement on the implied volatility. Delta is measuring the price movement of the stock. So let's go look and pick up option chain and look at the Vega and Delta. Where's my Thinkorswim? Now I'm going to have to use the think back feature because there is no option pricing right now for live option pricing on the weekend. So normally this would be my option chain that I'm looking at, trying to make my decision which strike price to pick. And here we see the Vega. You see Vega is not typically real big. And you see that Vega decreases as we get away from at the money. The Vega is the highest at the money. So we've got 5 cents, 4 cents, 3 cents. Now, what I was trying to explain about how this affects the price of the option, over here is our implied volatility. And we can see that it's almost 32.5% right now at the money at 41. Is this? Yeah, this is Friday. And so for every 1 point that this Vega or this implied volatility moves, our option is going to change by 5 cents. This $1.30 is going to change by 5 cents. That's a decent move there. If it just went from 32 to 31, we're going to lose 5 cents on our premium. However, the delta, here our delta is close to 50 right here because we're at the money. Our delta is 47 cents. So for every $1 that this stock price moves, our option is going to change by 47 cents. So these two work independently. You can have the stock price going up, but if the volatility is dropping, then you're losing money on this pair, on this ratio, while you're gaining money here. And so if this drops too quickly or by a big enough amount, it can actually cause your premium to go down faster than what you're making money on the delta as the stock price goes up. I think that's the critical idea in learning implied volatility, is to understand that it's not just the delta that affects your option price as the stock price is moving. This vega and implied volatility has sometimes a greater effect on your option price than the stock price and the delta. All right, I hope that's clear. Now, I wanted to show you some of the differences here. Let's go back in time. I'm going to back this up to the 12th. Now, first of all, I told you that volatility is relative in different ways. It's relative to the stock, first of all, and that's when we went to our volatility chart for a year and we looked at the comparison between implied volatility and historical volatility. That's how we determine what's relatively normal for this particular stock. Volatility is also relative to strike price. If you look at the different volatility here among the strike prices, you see that they're at different volatility levels. That's our vertical volatility. Remember I said there's vertical and horizontal. This would be your vertical volatility. We're looking at the same month, different strike prices. How does the volatility vary from one strike to another? The horizontal volatility is going to be from one month to the next. So I'm going to open up August. Now this is back on the 12th, okay? And I picked this example because it's a great example. This is NetApp, NTAP. It's a great example this week of what can happen with volatility and how drastically it can affect your profits. NetApp came out with earnings this week, and they did pretty good. The stock went up. But I want to show you how volatility affected what happened to this particular stock this week. So our horizontal volatility is looking at comparing 1 month or 2 months or 3 months to each other. And if you look here, we're going to just look at the calls. If you look at the difference in volatility for August, this is about a week before earnings came out and about a week and a half before expiration. Look at the difference in volatility in August and in September. These are in the 50s and 60s. These are in the 30s and 40s. This is horizontal volatility. Now, where this becomes important in your trading decisions is especially if you're making these earnings moves, if you're finding these earnings plays with best choice. Let's say you've got a stock that 9 out of 10 years tends to go up on this earnings report. Well, I've got 2 weeks to expiration. The earnings report is going to be out 3 days before August expires. I got plenty of time to sell it before it expires, and I'm going to know what the reaction is the day after they release that report. And this is a question that we get a lot. Should I buy the front month and pay less time? Because obviously if you only got a week and a half to expiration, you're not going to be paying very much time value. In fact, if we look at the difference here at the, let's say the 41 strike, we could have bought a 41 strike at 22 cents for August, would have cost us 3 times as much for the September. Well, you may tend to think, well, I'd rather risk less money. I'd rather risk the 22 cents. But if you're not paying attention to this volatility, you may lose money, and you would have on this one. I'm going to show you in a minute exactly the difference between these. Because the volatility for August was relatively high. What was our 12-month average on this stock? It was about 40, right? So we're pretty close. We're even a little bit under the September. We're a little bit under that 40% average for September, but we're quite a ways above it for August. So we can't just pay attention to the price or even just the delta here. We've got to look at the difference in this volatility. Now let's look at what happened in these volatility between the 2 months as we walk it forward towards that earnings report coming out. I want you to pay attention to this column and look at the months. We're 30s and 40s here, 50s and 60s here. I'm going to go ahead one day. There's the 13th. Well, this came down a little bit. This is about the same level. I think we're going to hit a weekend here, yeah, Friday the 13th. Let's skip through the weekend. Here's Monday. Monday we're back up in the 50s and 60s. Ooh, we're starting to see some 70s out here. We're still in the 30s and 40s down here. Now, the earnings came out on the 18th after market. Remember that. We're on the 16th. We're 2 days before earnings right now. 18th after market. Here's the day before earnings. Whoa, what happened? Look at this. Now we're getting well into the 70s here on our volatility. We're still in the 30s and 40s down here for September. Let's go to the day of earnings. Now, we still don't have the earnings report. This is the 18th, but it's not going to be released until after market. Look at this. We're in the 80s. We're even seeing 100% here for August. Where are we on September? We're still about average, 30s and 40s. Now, this is when most people, they jump in. If they're looking at the seasonals and they see an earnings play, oh, I'll just buy it the day before the earnings, or I'll buy it the day the earnings report's coming out. I'll sell it tomorrow morning. The thing's going to pop. Well, this one did go up to, actually I think it got close to 41, maybe it was $40. Now you see the effect. Let's back this up to the 12th. Where did we start on price? Let me back this up. If we're looking at this on the 12th, here's our 41. I'm going to highlight that in blue. I tell you what, let me give you I'm sorry, I'll give you a bigger screen here. We're going to highlight that 41 strike in blue. 22 cents on the 12th. Now look at the stock price. We're at about $37.50 on the 12th. Let's march this forward. There's the 13th. Went up a little bit, about 75 cents. Weekend, Monday, it's still at about $38, but where's our option? 27 cents. We bought it at 22. The stock price is still the same. Hasn't changed that much. Our delta's not affecting it that much. Our delta has gone up a little bit from 13 to 20, but the stock price hasn't moved enough to cause that much movement in the price. That's all due to this volatility going up. Let's go forward to the 17th. What happens on the 17th? Well, still at $38. Stock's just flat all week. My delta moved up 2 more cents, but if the stock's not moving, my delta doesn't help me. Why did this go from 27 to 32? Because the volatility went up. Let's go to the day of the report. Here's the 18th. Whoa! Now our stock did go up about 50 cents or so. So we gained a little bit on the delta. But look at this, we're up to 52 cents. But look where the volatility went to, 81%. Now, as I was saying, this is where most people would get into an earnings move. Oh, 52 cents, it's 2 strikes away, I'll buy it. It's actually almost just 1 strike away. This is probably at the money, is at the money of 40. 1 strike out for 50 cents, that looks like a bargain to me. Well, market closes on the 18th. They come out, they beat earnings. They've got good forward guidance. Everything looks good. Let's go to the 19th. Oh, what happened? Stock hit almost my strike price, $40.70. But I lost half my money. How does that happen? I'm now at the money, and I lost half of my premium. Look what the volatility did. Went from 82-something% down to 30. Now, why did that happen? Remember what implied volatility is. It is the forward guess of what the volatility is going to be on the stock. What happens when you're coming up to an earnings report? There's a lot of nervousness. We don't know what the report's going to be. Is it going to be good or bad? As that nervousness increases leading up to the report, that is reflected in the implied volatility. Then what happens once the report's out? Everybody knows what it is. There's no more nervousness. Now we know. The volatility drops, plummets, even though the stock went up and pretty much hit our strike price. In fact, probably during the day there was a point when it probably did hit right at 41. Now let's walk through this again, but let's do something different this time. We're going to start on the 12th. Let's say this time we're paying attention to our implied volatility. It's one of the things we're going to look at before we get in a trade. We always look at it, and we see on this horizontal volatility that the current month is a little bit high right now. It should be around 40, and it's in the 50s, even 60s on some of these strikes. But the next month out is about where it should be. So let's say we decide, because we know what happens leading up to reports, typically volatility increases. Let's say we decide to go ahead and pay the extra. We're going to pay 67 cents compared to the 22 we paid for August. Let's say we're going to go ahead and pay the extra and go the next month out, only because this volatility is closer to its average for 12 months than we are here. And let's walk this forward and see what happens. Well, the first day we made 10 cents. Volatility hasn't changed that much. Our delta went up a little bit. Let's skip the weekend. Monday we made another 10 cents. Volatility still at about 37, 38. Delta's going up a little bit. A few more pennies. We're still at the exact same volatility. Here's the day the report comes out. Volatility jumped a couple of points. Now that 2-point move in volatility was 8 cents. Remember, our Vega is the measure of how much our option price is going to change when this volatility changes 1 point. So we had a 2-point move in volatility. We made 8 cents in our premium just based on the volatility. But we also made a little bit here based on the delta. So we're collecting money or losing money both ways, delta and Vega. Now let's go to, now we're at $1.17, so we've steadily made money. We got in for 67 cents. We're up to $1.17. Report comes out after market. Let's see what happens the next morning. Well, it's up to $1.50. Volatility dropped a little bit, so we lost a little money on our volatility. But now we're at the money here. Our delta is almost at 50, so we made money on the stock move, and we didn't lose that much on the volatility. So we got in at 67 cents. We pretty much doubled our money here for September. What happened here? We lost 50%. Same move, same entry date, same strike price. The only difference was the implied volatility. And I'll show you that down here. If we go back down here, here are those two trades. Okay, here's our two trades. We bought one contract in TAP. We bought in August, and we bought a September, both at the same strike price, both on the same day. And even though this price isn't showing up here, if we back this up, we can see our entry prices on the 12th. Here's what we paid to get in each one of these. Here in August, we paid 22 cents. Here in September, we paid 67 cents. Got in on the same day, same strike. The only difference here is which expiration we bought. Now, let's look at our actual profit. Of course, the day we get in is 0. Let's look at our actual profit between the August, which is on the top, and the September on the bottom as we walk this forward. Here's the 13th. Oh, first day we lost $2 on August. We're up $6.50 on the September. Span the weekend. Here's Monday. Well, Monday we're looking better in August, but look at September already. Here's the day before earnings. Both of them still making money. Here's the day earnings is coming out this afternoon. Oh, we got a pretty nice profit actually. Now, why do we have a nice profit? Remember what the implied volatility was the day the earnings was coming out on the 18th? It was over 80%, right? Now, I'm pointing that out for a reason. I'm going to give you kind of a strategy that you may want to try out for some of these earnings moves in the future. But look at this. We've got a decent profit for August before that report comes out. And we've got a very good profit here for September. But look what happens the next day. Now remember, the stock hit our strike price, or was very, very close to our strike price. We were at the money the day after the earnings report. Here's the 19th. Actually, because this is not showing a price, I don't know why, but when I looked at this on the 19th, that's when I originally set this up, that was showing our 50% loss. But we made money on the September. The only factor that was different between these 2 months was the implied volatility. So the strategy that I wanted to point out is when we get back into an earnings season like October, you may want to try, as you're picking these earnings trades off the seasonal charts, you know, Apple goes up 10 out of 10, you know, we've got some great moves coming up in that October earnings period. By understanding how implied volatility affects the option price, and by understanding and looking at this example of how that implied volatility changes as you're running up, let's just go back up here and only look at August. As you're running up to the earnings, you may want to try kind of a, oh, what did I do? 12. Excuse me. You may want to try, I don't know exactly what you would call this, and this is probably a strategy that someone's already thought of, but it just occurred to me working on this for the past couple of weeks. You may want to try buying both in August and September. But you're going to be buying the August to make your money off of this increasing implied volatility on the run-up to earnings. You're going to be buying the September to make your profit on the move that Best Choice told you happens 10 out of 10 years. So what does that do for you? Well, we'll walk this up. Here we've got 22 cents. Let's walk it up to the 18th, to that 80% volatility. We're at 81% volatility. What we would do with our August contract is we would sell it on this day before the report comes out. We've more than doubled our money. We bought it for 22, we're up to 52. So if we had a contract in August and a contract in September, let's sell this one the day of the earnings release before that report comes out and make our money on the implied volatility. Then let's hang on to our September to take advantage of the effect of the seasonal move and the hopeful jump in price movement. And if we had done that, the day before earnings comes, or the day earnings comes out, we're up to $1.17 on this. Next day we're up to $1.50, and I think it might have, I don't know if it went up or down from there. No, it's gone down a little bit. But remember, we paid 60 cents for this, so we would have more than doubled our money here and doubled our money here. We're playing both sides of the earnings report, all based on this implied volatility. And you see the day after how this is called volatility crush. If you've ever heard anyone talk about volatility crush, this is exactly what it looks like. My stock price went up, I had the right strike price picked, but I lost money. What happened? You got hit with volatility crush. This sucked 50% of your volatility out in one day, which more than offset whatever delta you had working for you here. All right, let's see what else I had. Dun, 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 dun. I thought I had one other point. Let me just do a quick review. Gary, if you're still listening, I'm just about wrapped up here. I was afraid I was going to go long, so.
Actually, you're right on time. You've got another 24 minutes to keep going, Stan.
Let's see. And let me go back and kind of go back through this, because again, guys, just in trying to put this together, you don't know how many times I was sitting there, just had to go back and start over and get it all straight in my head. And again, volatility is not just critical in directional trading. If you're a spread trader, you really want to learn volatility, because it can really augment and help your spread trading. I didn't get into those kind of details. I'm not particularly a spread trader myself. Like I said, I like to keep it simple. Best choice tells me which direction it's going to go and when it's going to move, and all I have to do is watch for that move to start happening and get in the right position at the right time. And so anything that I can do to help fine-tune getting in that position and the right timing and the right strike price is, what I want to learn. But volatility can be very beneficial with spread strategies. Okay, let's just do a quick review, because I want to kind of get, the process, or get this outline back in your head. Volatility itself is just a measure of the range of price movement over a period of time. And I think most traders probably, when they're looking at volatility, look at either a 10, 20, 30 day chart, or I particularly like to look at a 3-month and a 1 year to get an idea of what's the normal range and the normal level of volatility for this particular stock. When the volatility is moving, or when the price is moving in a wide range, it results in high volatility. If it's a small range, it's low volatility. And I think just walking through that example in my think back, you can see why I say volatility is not a major factor, the major factor in determining the option premium. Again, when the market is pricing these options at different strike prices, 22 cents, 67 cents, most of the factors that go into the pricing are already known. We know which stock we're looking at. We know what the strike price is. We know what the expiration date is. Those things are known factors. The only unknown factor is that emotional quotient, which is the implied volatility. And that is what causes the fluctuation in the options premium, is the difference in the implied volatility. As volatility fluctuates, so does the premium pricing. I think we saw a good example of that as I was walking through that think back. There were 3 or 4 days in a row where the stock price didn't change that much, but our premium was going up 3 cents, 5 cents, 6 cents a day. It was all due to the implied volatility moving up leading up to that earnings report coming out. And the implied volatility is the only factor that determines whether an option is cheap or expensive. Again, we're talking about the difference between fair market value. Let's see if that's the next slide. We're talking about the difference between fair market value, which is comprised of these factors, which are all known factors. These are all things that we can know ahead of time. We can look at something and know this. We know what the stock price is. We know what the strike price is. We know what the expiration of the contract is. We know, or we can look up the current interest rate. And we know the historical volatility because historical is looking over the past. How much has this stock moved up and down? What range has it moved over the past? So historical volatility is already known. But your option price is not always priced at fair market value. And when you get a difference between market price and fair market price, it's all due to implied volatility. The rational component of the price or the fundamentals are all of those known factors. The emotional component of that price is implied volatility. And so when we look at the actual market price, when we're looking at an options chain, these four factors are still in there. Stock price the same, strikes the same, expirations the same, interest rates the same. But what that strike price is actually selling for can differ from what it should sell for based on what's the fear of the future, what's the market looking forward to, rather than looking back at historical volatility. So that's how we can tell if an option, a strike price, or expiration month is cheap or expensive. When we looked at the comparison between that August and September, getting in on the 12th, the August was up around 50% implied volatility. The September was down around 38, 40%. We know from looking at our 12-month chart that the average level of volatility for this stock was at about 40%. So we could immediately use the implied volatility to tell us that August was a little bit expensive. September was priced about right. And remember, volatility is relative. Remember I said one stock may have a volatility of 40, another stock may have a 60, but you've got to look at that 12-month chart and see where does that particular stock average on volatility. The one at 60 may have a 70 average. So 60 would be relatively cheap for that particular stock right now. The one at 40 may have a 30 average. So the 40 could actually be expensive and the 60 could be cheap. You've got to look relative to that particular stock. And then again, we looked at the relative to the expiration date. That's when we were looking at August and September. I showed you relative to the strike price. Again, there's a lot of stuff you can learn about Volatility Smile that is basically charting the different levels of volatility between all the strike prices, and if you chart it, it actually makes a smiley face. That's why it's called Volatility Smile, and I didn't want to get into that much detail today. And then also, I don't know if I showed you, but calls and puts will differ slightly in volatility. And again, that's due to the direction that the market or the stock is currently moving. If the stock's moving up, then there's going to be more nervousness on the call side than on the put side. So as the stock is moving up, your calls are going to have a little bit higher implied volatility than your puts, and vice versa. Now I was going to show you glad I went back through this. I was going to show you where I got these charts. Now, hang on. I meant to say something in the beginning. You know, Gary and I will a lot of times talk about websites that we pull information off of, or even using Thinkorswim. There's lots of resources out there, guys, to gather this information, and we're by no means promoting one over the other, you know, or ignoring one and saying this one's any better. These are just the places that we found to get resources. So don't read anything into this. But I was going to show you, if you want to pull up these charts, you don't have to pay to get on this site and look at these basic charts. You can sign up. You can sign up and pay a subscription if you want to get into really the detailed information. But I got that chart off of here, iVolatility. And in order to access that chart, you do have to fill out a registration, basically just your email address. And they do put out a nice weekly newsletter that has some good information, but you don't have to pay anything to register. But once you've filled out a registration with your name and email address, you can access what is called the basic options here. I'll click on that. I'll show you where I found that one chart. And all you do here, right here, is put in your whatever stock symbol you're looking at. I know Gary's going to, I think, talk about CRM. That was a nice move this week. Really nice move. I wish I had listened to you, Gary. I was a little skittish about it. Didn't take it. Could have 5 times my money. Well, we all make mistakes. All right, so I put in CRM up here, and you can see it shows me, you know, some of the actual numbers. I can look at the current volatility. I can look at a week ago, a month ago, the 52-week high, 52-week low. And down here, it gives me some different strike levels for the current month. Now, you can pay, I think it's $15 a month, and you can get all the other expiration dates. But I mostly use this chart right here. You see there's a price chart on the top, there's a volatility chart on the bottom. If you just click on that picture, it brings up an enlarged chart. And here's a 1-year chart on CRM. Now, if I were going to guess, I would say that it's probably, if we average this out, it's probably going to be up around 45. So we can see right now that the implied volatility is high on this. The historical was low, but let's get to 3-month here. I see that historical shot up probably on that earnings. Look what that historical did. See, this implied was rising. That's a very quick reaction on the historical, and actually looks like the historical's up here at about 60. So anyway, I wanted to show you that's where I got those charts. There's lots of other good sources. I think if they're still around, OptionView used to have some charting. But there's a lot of sources that you can find for your charting, options charting software. And then we talked about Vega, and I hope that I got that across, the difference between Vega and Delta. You got to remember Vega, if it's a 4-cent Vega or a 2-cent Vega, that's a measure of how much your option is going to change based on whatever that implied volatility level is. For instance, when we saw that volatility drop from 80% to 30%, that's a 50-point drop on the volatility. And if our Vega was at 2 cents, that's a whole $1 that we lost just on the volatility drop. Now, the stock went up $1. If our delta was 50 cents, how much do we make on the delta? When the stock goes up $1, we made 50 cents on the delta, 50-cent profit on the delta. But that 50-point drop on the volatility at 2 cents per point was $1 we lost on the volatility. That's the best example I can give you of volatility crush. When the stock moves your direction and you still lose money, it means you lost more money on the vega and the volatility than you gained on the delta and the stock movement. All right, Gary, I don't think I can, well, I was going to take this slide out. I had one other little, I'll go ahead and do this. I had one other little analogy I was going to use. This is actually a book that I bought. The title of it is How I Turned $1,000 into $1 Million in Real Estate. This book was published in 1959, and I'll tell you the story behind it because it applies to everything I've been talking to today. Back in 2004, when the real estate market was just hot and heavy in Florida, everybody and their dog was, buying property and either flipping it or renting it out. So I fancied I was going to be a real estate investor and, do like everyone else and take equity out of my home and go buy rental houses, right? Well, I read an article in the paper one Sunday, and the columnist said this was the best book on making money in real estate that had ever been written. The title is How I Turned $1,000 into $1 Million in Real Estate. Now, again, this book was first published in 1959, so I just had to have this book. So I got on the internet and started searching. Found it on eBay, and it was being auctioned. Now, this book was out of print. You couldn't order it. It was out of print, so you had to buy an old original issue. Well, I just had to have this book. And I bid and bid and bid all week, and I bid until I won it. And I ended up paying $159 for this book from 1959. Now, since then, we all know what's happened to the real estate market. I still have this book, by the way. I never did get into buying rental houses. Just never got around to doing that. But since then, the collapse of the housing market, I went online today and I looked up on Amazon or eBay and found this book for sale. You know how much this book is selling for today? $5. But I paid $159 for it. Now, it's the same book. It's got the same number of pages. It's still out of print. It's still a collectible. The only thing that's different is the emotion for people to have this book is gone. In 2004, everybody wanted this book. Now, you can't sell it for the paper. And that was my last example I was going to show of how implied volatility is so important in the option pricing. It's that emotional component that causes the big fluctuations in that options price, because everything else in the price is equal. The stock price, the strike price, those all are equal at all times. It's that emotional component. And implied volatility and vega give you a measure of that component that you can use to your advantage to either avoid getting into a bad spot like that August contract, or to maximize your profits with either a strategy like buying the August and selling it when the volatility is high, or going on out the next month because you see that the volatility one more month out is more normal than the current month. All right, with that, I'm going to turn it over to Gary. Do you think we need a break, Gary, or you want to just keep going here?
Well, let's pull everybody. You guys tell us what you need. You need a little bit of time to...
We could do a 5-minute break.
All this wonderful stuff Stan talked about. Gel a little bit. We can get up, stretch your legs a little bit, and then I can break.
All right, break. Let's take a 5-minute break and come back at exactly 1:30 here.
Sound good, everybody? Say yay. We got a 5-minute break? Okay, 5 minutes, and we'll come back at 1:30.
All right. Okay, everyone, welcome back. I'll give everyone a few minutes to scramble back to their computer here. While you're doing that, I had a couple of thoughts during the break. One thing, I mentioned in the beginning that we're doing these advanced trainings, assuming that most of the people that sign up for the advanced training have already had our basic training or worked with a coach. If you have not gone through the basic training, it's about an hour and a half, 2 hours long, to specifically show you how to find trades in Best Choice and how to use the software. Call the office and find out which coach is assigned to you, and get with that person and schedule some time with them to go through the basic training, because without the basic training and not using the software properly, you're still going to be lost on finding trades. And along those lines, I said that I'm a pretty simple directional trader. I just buy calls and buy puts based on the seasonal. But I know I've got a lot of my customers, and there's a lot of you probably that may do the spread trading. And we do have a resource in the office. One of our coaches, Scott Macbeth, is pretty much an expert on spread trading. So if you want to apply some of these principles that we're teaching, and especially apply the Best Choice software, there's definitely techniques and ways to use Best Choice to enhance your spread trading. So I really want to encourage you, if you want some help in those areas that I'm particularly not experienced at, call the office and set up an appointment with Scott. He is the expert, the resident expert. All right, well, Gary, are you online here?
You bet. You bet. Ready to rock.
Okay, well, I'm going to let you take it away, and I'm going to see what nuggets of wisdom you have to offer.
What a great lead-in. Good afternoon, guys, and welcome to the second half of our advanced training here. Hopefully you guys got a lot out of the implied volatility versus historical volatility. It's really great stuff, and actually Stan's taught me a lot of stuff in regards to that. I'm going to be talking about more in regards to entrances, more refining your entrances after Best Choice gets you the setup, managing the trade as you're in it, some key indicators that I look at that I've been able to glean from other very successful people as well as myself, and exit strategies as well as target. I think it's very important that whenever you're trading, you should always know what your target prices are, where you expect the underlying security to either extend to or retrace to. And in that, one of the tools that I like to use is Fibonacci retracements or extensions. So I do want to go over a little bit of that. I am going to be using my paper trade account at TOS and the charts as well as Profit. For you guys out there who are not real familiar with that platform, I will go over briefly how to set up these specific indicators. I know a lot of people have asked me for doing that, so we'll go over that in brief. And what you don't pick up on during the live presentation that I do now, you will obviously be able to get the CD or DVD and be able to play it, and then it gets hardwired into your brain. So that's kind of the format. I don't have a PowerPoint that I go by. I think anybody who knows me out there knows I talk, and I try to ingrain this all into people's heads. But it's good that we're recording this, because then you can replay it later on. One of the trades that I want to go over starting out with is one that I was talking about and traded this last week. And, there's several people I speak to on a weekly basis. We kind of exchange ideas, what we're looking at, and what's the setups, and kind of a pulse of the market and so forth. And that was a really great company called Salesforce.com. Stan kind of alluded to it towards the end. The symbol is CRM. And this was a stock that was on my radar list. One of the things I like to do, and it's important to remember, Best Choice is a phenomenal setup tool to know what historically expect a stock to move. based on their seasonal charts. We use the linear regression lines to verify whether the stock is overbought or oversold. In today's economic climate, I generally like to use 6-month charts, but I'll look at different time frame guys as well. I'm looking at 819 here. If I go to the 3-month chart, I'm always looking at what extreme of price movement is that underlying security at, because these charts are very, very powerful tools that give us the pulse of where that underlying security is at in today's economic climate. The seasonal chart gives us what we expect historically that stock to do at this time of the year, as well as the average percent move that we expect the stock to move to. And that gives us our target prices. And it's important to have those written down. I call it T1, T2. Where's my first target? Where's my second target? And I'm going to verify and look at that with Fibonacci extension or retracements. If I'm shorting the stock, buying a put, then it's the retracements. If I'm playing it long, like on CRM, which was an event-related trade, stocks move because of an event. Earnings are an event. Holidays are an event. These are things that trigger emotion from the consumer. The consumer reacts either positively or negatively. Leonardo Fibonacci was a 12th century mathematician, brilliant guy, who really kind of learned what we call the golden number, which, for you people that don't know that, it's 1.618 or 1.62 that some people rounded up. The one 6.82 is 6.2. It's found throughout nature. You could actually take any section of your index finger from the tip of the base to the wrist, and it is larger than the preceding one by that Fibonacci ratio. You could take and measure from your hip bone to your ankle and multiply it by 1.618, and it's actually the height of your body. Fibonacci understood this. He actually studied it by studying seashells and swirls in seashells. So it's found throughout nature, which, we're all part of nature, and so is the markets, because the market is consumer perception and how it moves. So it's a very, very powerful tool that I like to use to give me and help me determine what my T1 and T2 would be. And it allows me also to, that along with a couple of other indicators I'm going to show you guys today, that when I'm in a trade, what typical profit taking will be, where you'll find retracements. And that's where a lot of people go, stock's going against me, time to sell. And how many times, all of us, including myself, we don't stay in a trade long enough and realize we left a lot of profit on the table, or vice versa. In a losing trade, we're hoping and we're going based more on emotion or fundamentals, or I know that this thing is going to go in my direction. So many of us end up learning that hard lesson of revenge trading. But these fib numbers and those dollar amounts associated with the T1, T2s allow you to say, it hits this level, one of two things are going to happen. I'm going to take some contracts off the table and let the rest run. It's a very common practice that floor traders do. Is if you're, it's kind of called, I call it the 80-20 rule. Say you got 5 contracts on a position, it's hit your T1. Depending on your risk adversement and your risk tolerance, you take 80% off the table, sell 4, leave 1. That's called leaving a stinger on the table. And that stinger, a lot of times, if the underlying security continues to bust through some of those fib extensions, if you're playing it long and buying a call, boy, it could take you to the moon. So think about that when you are trading. Is the 80-20 rule. Some people like to take 50% off the table, leave the other 50 ride. That way you've got, built-in profit, and now you're playing with the house's money. So let's take a look at CRM. It was a great, great trade that happened this week. A lot of people I told made some serious money. One of my users who had bought the software back in December, he's really an incredible trader. I don't know if it's dumb luck or he's just a real risk taker, but he traded this, bought 100 contracts on this particular stock, and it is an earnings-related trade. So let's take a look at seasonally what happens with this thing. Remember, the blue lines are the historical price movement of every year on the stock. The yellow line is the composite average on everything. Remember, the green dots are the earnings releases. And this is an event that the consumer reacts to either positively or negatively. Whenever you snap on a seasonal chart, wherever you're looking, the software is always looking for one thing, because tab 3 is defaultly set at best rating of whole zone. Now, I've got it set for 21 days. Defaultly, it's set at 14 days. Because of the way the algorithms are written in here with 365 calendar days, 52 weekends, and 9 federal holidays last I checked, unless some new ones have been introduced. That leaves us 252 trading days. Well, those weekends and holidays do not necessarily fall on the same day from year to year, and so when you're looking back into history to account for that variance, you can change this in increments of 7. So keep that in mind. So when you snap on here defaultly with it set at 14 days, looking for the best rating. Remember, that rating is a mathematical formula that Pete developed. The win percentage multiplied by the average profit divided by the average number of days. So you have 2 numerators and 1 denominator. So the lower that denominator, the higher the rating. The higher the win percentage, the higher the rating. The higher the profit, the higher the rating. So it's a formula. When you're snapping on that, it's trying to find that best rating, which is really cool. We got a nice high rating. We see it 6 out of 6, 100% win. Well, folks, look at that start date. It says 8/31. Well, wait a second. Kind of see that the earnings here, and this is a trigger for me to say, man, this is probably related to earnings. When you're snapping on this thing, it just keeps giving you that start date here. Well, I knew that earnings on CRM was coming out this Thursday after market on the 19th. So I said, well, wait a second. Let me see if I can get an earlier start date with the same win percentage. So I went to tab 3, changed this to 28 days, increments of 7, snapped this whole area to see if I could get the same win-loss percentage or perhaps an earlier start date. So when I let go, it gives me a nice green rating, but wait, there's 1 year that's a loser. But look at the start date. That's what I was looking for. Boy, and that's a huge move. Big, big move. And I'm always looking at historically that percentage move. I see some really good consistency in there. Boy, is this a consistent player. When you do some fundamental research on the company, which, guys, anytime you're trading a company and you're putting your hard-earned money on the table, find out a little bit about the company. And you can do that right from the software by going to the Extreme Chart, clicking on link to description, which immediately takes you to MSN Money, and it'll give you all the fundamentals that you need to know about that particular company, what industry they're in, what exchange they're traded on, their PE ratio, and so forth and so on. Well, this company, Salesforce.com Incorporated, is a provider of new technology, folks, called cloud computing. Cloud computing is going to revolutionize and transition everything we do over the next 10 years. A lot of applications and things we do now on the desktop and our laptops will become applicable and easy to do on mobile technology. I know this because my son just graduated from Georgia Tech with high honors, and he interviewed with Cisco and Microsoft and Bloomberg, and I guess he wasn't done with Atlanta, and he decided to take a position with a satellite office of a small company. You guys probably haven't heard of it. It's called Google. And he's actually in the division of mobile technology. And he told me all about this, and I didn't understand half of what he told me. But this is fantastic technology, and this company is an incredible company to be poised to take advantage of it. Another company, you could probably write it down, is VMware, virtual machine. They're going to be very, very big in this industry. Anyways, learn about the company. So, and this company has smoked earnings the last 14 quarters, so that's real strong. So remember, that's built into the software that you can check out by just clicking on the link to the description. As well as you can click on tab 2, and that gives you kind of a basic overview. If you want to dig deeper, go into here. So it's important to know that. So I was looking at this. This was on my radar. I was looking at a 6-month chart, kind of like what Stan talked about as well. You know, the width of the bands. I always try to teach this in my basic training. There's a 5-bullet point you want to recognize when you're looking at these charts. It should be a Blake method, and you should immediately say, wow, this is good or bad. And you either eliminate it or say, I want to take a look at it this year. I really don't care what seasonally does, because this chart tells me what's going on with that security in today's economic climate. And this thing's got a good spread. 107, 97 to 107. That's a $10 spread. $10 on a stock that closed at $96.41. It's $12. Sure, I'd like to see it 15%, 20%. The larger that volatility with directional trading, when that stock moves in our direction, and like Stan said, if you're buying with low implied volatility going in, and the stock smokes in your direction, your implied volatility explodes as well as your delta, and that's the kind of way you can make a lot of money. So I'm looking at this. I'm looking at the extreme, 7.2, cool, telling me it's way oversold. I go to a 3-month time frame. It's telling me the same thing, oversold on a shorter time frame. I'll generally flip to those 2 time frames. More time frames, I can confirm that the stock is either overbought, if I'm shorting it, buying a put, or oversold, if I'm playing it longer, buying a call, the better. A lot of people ask, oh, which time frame do you look at? Folks, a lot of times technical analysis is an art more than a science. So you just start recognizing these things, looking at these charts day in, day out, day out. Generally, I'm going to use 6 months and 3 months. So I saw that this thing was really, really set up. I did my research on the company. I was looking at, well, what do I historically expect this stock to move? And I changed tab 3 to 28 days to try to get that earlier start date. And I saw, wow, 20.5%. That's huge, huge movement. With big, big point and percentage movements over the last 4 years, except that 1 year. I'm willing to play those odds. Some people aren't. But I knew this company was real strong. The other thing you could recognize, if you do it just on the default 14-day setting and snap the year, it's 100% win. You still got good consistency over the last 3 years. You could say, well, I'm going to be more conservative. I'm going to say, on average, that stock is going to move about 12.4%. Again, folks, that's an average. Could be more, could be less. So if you use that number as a conservative number to say, that's how much I expect the stock to go to, and you were on a 6-month chart, and you took out your trusty calculator and did the math. It's pretty simple math, folks. The stock closed at $96.41. So if I put in $96.41 and multiplied that by 1.124, a 12.4% move, that's going to give me my average target of where I could expect that security to move to. It's 108. Well, 108, guys, is a little bit past that 90% of price movement, isn't it? And this strike increments were in $5. So you'd have to look at the 105s or the 110s. I'm a conservative trader. I go based kind of on Pete taught me how to trade with this software, which really works. Is you want to pick that strike price between the 50% of price movement, the mid, at 90% of price movement. That's what we call the sweet spot right there. So it'd be the 105s. And I was looking at this on Monday. I wasn't looking at it here day of earnings release. This was already on my radar. So if I move this back to the 16th, it's still showing me it's way oversold, right? So, and I knew earnings were coming out Thursday. I may have dealt with a little whipsaw of the going up and down.
Hey,
it didn't matter because I wanted
Gary.
this thing. Yeah.
Real quick, a plug for Best Choice. I just thought of this. You said you knew when earnings are coming out. Would you quickly show them the new link that was put in with the last update?
Oh, yeah.
Yes. Sorry to interrupt.
Help me out. I haven't looked at it.
Current stock. Current stock.
Okay. Current stock. Oh, there
right
it is.
There,
okay.
briefing.com.
This is one of the things we've asked. I don't know. Anybody who's gone through my training knows I always have MarketWatch and briefing.com. These are some of the two tools that I use out there. Briefing is a great site to find out when an individual security is releasing its earnings. Very accurate. I've never seen them not, be off on the date or if it's before or after market. So I knew this was coming out. All I have to do now, it's built in. We probably convinced the programmers to put this in. You'll click that and it'll take you directly to briefing.com. And all you have to do is, and it'll take you right to the simple. Ooh, that's cool. I didn't even know you had to do that. That's really great. So I knew that earnings, as you see right here, was coming out on August 19th. So I knew that beforehand, and that was put into, I hope I did this, guys. Yep, I did. Good. Tab 4, you can put that info in there, when you're looking at things beforehand. So, it's right there in the software. You're not bouncing all over the place. So I knew it was coming out on the 19th after market, and that's where the earnings were. So thank you for helping me out, reminding me of that, putting in a plug that Stan and I pushed for this to have these two links put in here, which are real cool. So now you can go right to there, find out when earnings are coming out. Okay, so I was looking at it here, and once again, even on this date, the 16th, that 105 was smack dab between the 50 and 90% of price movement. Cool. So my only remaining question is, what does that cost? Now, I'm not going to be buying spot month, folks. I've been burned on volatility crush too many times. Google's burned me doing that 3 times the last 2 years. Not going to do it again. So I'm always buying the next month out, especially when expiration Friday is the next day. So buy yourself some time when that happens. That way you won't experience any volatility crush like what Stan went over. And you can look at that on whatever your brokerage firm is, what is implied volatility for that month versus the next month out. All right, so if I saw that this was the 105 and I saw it was a decent price, I think I paid about $2.15 for that September 105 call. And $2.15 on a stock that's $96, so what am I paying? About 2.2% premium? It's within my general rule of 1 to 3%. Like to keep it cheap. Cheaper the better with low implied volatility. So it was decently priced for me. So then I said, all right, where could this thing stretch to? Let me do some Fibonacci extension on this. So let's do that. I got to bring up the screen. Can everybody see this chart well? Give me a comment on here so I can see it. Yes, no? Everybody see it?
Yeah,
okay,
it's good, Gary.
It's good? Okay. I know this is a tight-looking chart here because I've got it set at a 90-day All right, this is on charts, by the way. You know, there's 3 different charting programs. There's Profit and FlexGrid too. I like them all, and I use them all. I have set linear regressions on this, folks. I want to go over that right now so you guys know how to do that, for those of you that don't. Under Studies, if you click Studies and click Edit Studies, a big window pops up. It defaultly opens up on the left to Studies, and you can take the scroll bar down to the L's. And I want to thank Thinkorswim. I love their platform. I'm not endorsing or not endorsing them. I just like to use their platform. It's under Linear Regression. It is Linear Regression Channel Variable, VAR. All you have to do is double-click it, and it'll appear under Strategies, Studies on Upper Graph. Defaultly, it opens to close. The width of the channel is 100, full range yes, and the length is 21. Where I've set these at, which are pretty doggone accurate, is I'll change the width to 60. Keep it at price at close and full range, but I changed the length to 20. Now, I've tried to hardwire my brain to where any colors that I see are almost identical, if not identical, to what I see on Best Choice. Black background, 3 yellow lines. Black background, 3 yellow lines. So I'll change the color, folks, down here for the middle, upper, and lower to yellow. All you have to do is click the color, change it to yellow, upper, change it to yellow, lower, change it to yellow. Make sure you keep that bubble to show the bubble, because then that shows you what that lower band price movement is, middle band price movement is, and upper price movement is. And it's real close to Best Choices. Best Choices, of course, proprietary. I've never been able to exactly duplicate it, but it comes real, real close. It's a real powerful tool to be able to use. Okay? So I like to use that. I'm going to remove that particular one because I've already got it set up right here. See? I have a 10-period exponential moving average and a 20-period simple moving average. These are other indicators that I use that are very helpful, folks, and I use them very, very heavily. There's MACD set at 12.26.9 EMA, a %R set at a 20 length, and a DPO, or detrending price oscillator, set at 14. 14, close. I'm going to show you how I use those in a second, but right now I want to just demonstrate the Fibonacci extension. I'll leave this up on here so people can just see this, and that way it stays on the DVD for anybody who wants to be able to duplicate this. Moving average, close, 10, display 0. I've got it set at red, because that's what I have Best Choices set at. Simple is close, 20, 0. And again, all of these are here. The moving average is under the M's. It's the first, there's the moving average exponential right there. But the simple moving average is not under moving averages. It's under the S's. But you scroll all the way down to the S's. And it's your first one right here. MACD, of course, is under the M's. Now, there's a lot of MACDs, guys. The one I use is MACD, not MACD histogram or MAC histogram crossover or MACD two-line. Just use the MACD, which gives you the histogram and the two lines. Very powerful tool. The percent R, Williams percent R, is all the way down with the W's right here. And all you have to do is, when you defaultly click on this, folks, it's going to give you a, well, I've got it already defaultly set to open up at 20. That's not going to be the length when it defaultly opens up. I think it's a 30 length, so change it to 20. The DPO, or detrending price oscillator, very good tool, helps you stay in a trade. I'll show you how that works in a second. Is under the D's, detrending price oscillator right there. When you open that up, again, I've got it to default to open up to 14. That is not what it defaultly opens up to. It opens up to 20. So you've got to change it. Okay. Any questions on that, real quick? Okay, I don't see any questions, then I'll move on. All right, let's look at this particular trade, CRM. I have this set under Style. I like to use Heiken Ashi candles. You get that under Settings. When you click Settings, under Scale and Access, I like to have the expansion to be 10. That way it doesn't stop all the way here, even though I've got this form fitted right now because I want to show you this. Appearance, under chart type, I like to use Heiken Ashi. Study up on that, guys. It smooths out the candles patterns. Helps me stay in a trade. Helps me follow the trend a little bit better. I have my background. Defaultly, the background color is set to this blue. I don't like it. So I've got my preset background color set to black. Under equities, I've unchecked show volume and unchecked highlight extensions. All right, that's how I set up the background of the chart. Okay? Under drawings, you have all the different types of drawings you can do. And I'm looking to do a call position. And I've already done all my research with best choice, picking my strike price, the 105s, pricing them, seeing is that good value, what percentage is that of the underlying security, all those kind of things. Trying to pick my T1 and T2. Where does this stock have the potential to go to? I'm going to look at this chart, and I'm going to click on Drawings, Fibonacci Extension. My cursor turns into a pencil. I'm going to take it for I see the previous low hitting below the linear regression. Click it. And I'm going to take it up to the high, the peak high. Click it. And then draw it down to the last candle. I lost it. Let me blow it up a little bit. If I blow it up, it's going to show that whole big part. I don't want to do that, so let's try it again. There we go. And then to get rid of that, I'll just go back to a pointer. Now, I'm going to probably want to get a little bit more accurate. And I know you guys can't see this. I'm going to show you how to adjust that so you can see it better here in a second. I want to get these numbers because I just snapped it from here to here to here. So I know this stock exploded, but I want to know what that price is. And remember, guys, here is the open, high, low, close. I want to take it from the low here to the high here to the close here. Low to high to close of that hourly bar, of that 2-hour bar. So I want to get a little bit more accurate. So what was the low of that? It's $84.38. You see it here. Now I got to move this forward just a little bit so I can get these lines. That way I can click on this and edit that particular property. So this low right here was 84.38. That was my beginning point. So I'm going to change that to 84.38. My middle value was right here. That was the high. That's my middle value. What was the high on that? You can see it over there on the left, guys, 104.44. So I want to change that middle point to be exact. And then what was that close of that bar that I set it at? On what date was that? The end point date was on the 19th. I'm going to actually move this back because that's, well, that's real close. We can keep it at that. Or is it closed at 90 on the 19th at 14? What was that? Closed at 98.93? Nope, that's too high. Yeah, 97.34 is where it closed at. 97.34. So 97.34. Okay? I'm going to change these colors so you guys can see it better. Okay? And click OK. All right. Now I'm going to blow this up. Here's Thursday. Now let's just see. Well, it's way back then. Here we go. All right. Here is your Fibonacci extensions, which you have a 23, 38, 50, 61.8, 78.6. Keeps going. There's 100%. And there's a golden number, which is that 161.8, which a lot of people will take profit off of. But you see something very interesting here. We were picking the 105 strike. Remember that, folks? Remember this on here? We picked it between the mid and the high, the 105. We priced it based on the average percent historical move, all that. And so I'm looking at where is that in Fibonacci extension, which is initially resistance. 102, 105. These are all resistance points. Now, very important, guys. You see that 38.2 or the 5.0. You're typically, and if I got this into the minutia of these, remember these are 2-hour bars, okay? If I got into real tight time frames of 5-minute, 2-minute bars in this area, it's going to show price is going to be bouncing off that. It's just not going to smoke through because these are resistance levels. Once they bust through, they become support levels. But very typically, 38 and 50 are profit-taking. When you are in trades, be in a longer time frame when you see these hitting that, and you see the stock turning against you. You don't see it blatantly here. This thing just smoked and busted through all of these. But very typically, you'll see it hit up against that point, the 38.2 or the 0.50, and the stock will start retracing against you. A lot of people get scared, take their money off the table, and then suddenly the stock man, I know that's profit taking. I'm going to stay in because I know it's going to hit that 38.2, that 50. There's going to be profit taking. The stock's going to bounce off of that, and it's going to turn around and keep running through. You see where it stopped right there? You can see how it's bouncing right here. It's amazing the stock is busted through the 618. That's usually a turnaround point. But where I see it more often than not is it'll run up to the, there's actually one in between this, folks. It's a 707. I just have not set it. I'm just using the default ones, but there's a 707 in there. It busts through that. Boy, that puppy continues to run. This thing's a very strong runner. Now, how can you continue to manage to stay in that? Let me add some of those other studies that I was talking about. I'm going to add in this MACD to start one at a time. You can see a nice crossover, and that MACD keeps you in. Let's throw on the percent R. Actually, no. I want to throw in the detrending price oscillator first. Show Stan this. He's really liking it. When that DPO, detrending price oscillator, busts above the 0, boy, that's a real strong comment. And it's staying up here. This allows me to stay in a trade. I can tighten up this time frame even. You could probably see it a little bit better. So this helped me pick my targets, guys, too. See that 107? Where did we expect that stock to go to? Remember? We did the math. 108. That was an average. Could be more, could be less. We picked our strike price right there at the 105, which is between that mid and that high. This is exactly what the best choice showed us, between the mid and the high. It's that this stock had legs to continue to bust through that, which is exactly what says, where's the next level it could go through? If it busted through that 107, where's the next one it could go to? It could run to 109. There's probably some selling off in this area, and then it busted through that. Where's the next level? 113. See, this can allow you to stay in that trade that whole day instead of saying, oh, wow, let me get out here. Gosh, I made money. Let me take my money off the table. Well, no, when it hits that 105, great. Again, you can use the 80-20 rule, depending on how many contracts you have, or the 50-50, whatever you're comfortable with. I'll normally take 80% of my position off the table and leave 20% for stingers and let them run. Let's add in the last study I like to use, which is the percent R. Very, very strong. Now, I've put in this green line in here to be able to visually see where that 50% mark is. So when I added that Williams percent R study, first of all, I put the oversold at yellow and the overbought at yellow. Defaultly, it's not. It's red. I like these colors only because they just jump out at me. By the way, it's the same colors I've hardwired my brain on to see these in best choice. So to add this line where you can visually see the line spike up above the 50 is go to Drawing Tools, click on Price Level, turns into a pencil again, and you could snap any place you want. You could see where the number is here. You're trying to get it close to the 50. It doesn't matter. Just click it, turns purple, and then click it again. And put your cursor right on the line, right-click, edit properties, and change the color to green. That's all you got to do. And I like to extend the left ray, which means it goes all the way out to the left, so it's showing that way. And extend right ray is default. Then to change it to be exactly 50, just highlight that, put a negative 50.0000. Or you don't even have to put the zeros. Just put a negative 50, click OK, and then it becomes exactly right there. There's actually two of them there. I got to get rid of one. And see, it shows me price level 1 and price level 2. I just added this one, so I'll get rid of it. So that's how I visually add that. And again, to get rid of that pencil, go back up the drawings, click on pointer. All right, here's all my tools, guys. It allows me to stay in a trade. And gives me the confidence to keep it. Now, another thing that you've noticed, I have the 10-20, right? The 10 exponential movement. As long as price stays above there, I'm staying in. I got my targets too of where I know where the next shot it could go to. Again, this is a lot for people that can watch things on an intraday basis. This was a major earnings play that really exploded. So you bet I was watching this. So were a lot of other people. I mean, believe it or not, I believe that option. Hey, Stan, do they have option prices over the weekend? I don't remember if they do.
You have to use a ThinkBack, Gary.
I
do
can't
the ThinkBack. Just do the ThinkBack and click on Friday's date. It'll show you the closing prices.
Oh, okay. I think I already got CRM up. Let me get rid of it. Okay. CRM. I think I got into it on this. I did. I got into it on the 16th. About September's. All right. Here's an important thing. I think Stan was bringing this up. Let's just kind of look at this as well. You know, I've got some custom layouts that I like to do, and you can do that, folks. A little monkey wrench where you can adjust what your layout is. How the heck is that son of a gun, Stan?
No, just open up your layout and go to Customize. Drop down, yeah.
Oh, yeah. There it is.
Go to Customize.
And you click Customize. Then a window, and then you can add whatever you want. I've created this specific custom layout that I like to flip to. Let's do that again. See under Layout, open up the window, click Cut. Because defaultly it's the Greeks, which is no problem. I mean, Delta Gamma Theta Vega is fine. But I'd like to have this one, which I use. Anyways, so we're looking at the 105s. The bid is 210. The ask is 217. And implied volatility was in the 40s. Probability of touching was pretty strong. Probability of expiring was pretty weak. Let's compare that to buying the next day, 105s, or the front month expiration. You can see the difference in volatility. Probability.
Hey, Gary?
Yeah.
Gary, right in the middle of the top, it says strikes. If you'll set it to like 4 or 6, you can get both months at once.
There you go.
Both months at once.
There you go. Yeah, you can see here the spot month was 57. Not that great a disparity like what Stan used, but again, that's just another point to see how much more there's fear and there's those bidders and sellers on that are pricing that, driving that implied volatility up. Okay. Let's buy that for $2.15. And where was it at? I was going to the 19th, right? So I had a little bit of money, not a lot. Paid $215. But wow, What a home run, guys. And this thing still got legs to run. It's still got strength to go. I was trying to make a point here. I lost my train of thought.
Hey Gary, go back to your chart. Where's it currently? It's at the 78% level. That could be a strong turnaround.
Yeah, just be aware, guys. And again, you made Gizo Pete's. You paid $215. It's worth $820. What kind of return have you guys made? You know, I mean, by this time, any place along these levels, you'd probably take profit, but leave some stingers and let it run. That's my whole point. I'm trying to do on that.
Hey Gary, could I point one thing out on the Fibonacci?
No, I didn't interrupt you. I got two more to go. And
but talk about the difference. Talk about the difference between the profit-taking levels at 38 and 50 and the turnaround points set at 0.7 and 0.8, and especially the.
Well, yeah, guys, I will tell you that number right there. This is what is used by all big traders. If you were playing much more of a longer-term position, that number, because it's so universal in nature, that's really a target on this puppy over longer time. And that's, guys, if you're in position, get out. If you're looking for a swing trade to sell on it, that's a great pivot to get in. All right, I want to go to another example. That was one that we just did. It was really great. But hopefully, folks, can you see how putting on Fibonacci's extensions gives you your target prices of where that stock could go to, and where at those target prices that our resistance, if they bust through, becomes support. But at those target prices that are resistance, there's going to be some profit taking. You'll see some retracement coming out of that. But then know, with these other indicators, using the percent R, if it's above the 50, if it's not busted below the top line, I'm staying in. If my DPO is above this, it's not turned down or crossed the zero, I'm staying in. It gives me the confidence to stay in and manage that trade.
Hey, Gary. I'm going to do it to you one more time. One thing I notice on this, even though your Williams and your DPO is still keeping you in the trade, that price, what time frames are you using here? Is the hourly?
Yeah, it's an hourly chart.
Yeah, that has tested that 78% level 3 times and has not broken through it.
Well, let's go to
that may be all it has to go.
Let's go to a 10-day, 30-minute. You'll be able to probably see it a lot better. Go to a 10-day, 15-minute.
Yeah, it doesn't matter. You see how it has not broken through that 78?
Yeah, there it is.
To me, that would be a warning sign of, better start thinking about an exit.
But see, you would have had all these numbers already set up, guys. You already have these written down as target. That's the whole point. So you know where, if it busts through the 105, our strike, great. See how it meandered sideways, 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 sideways? Then it finally busted through and closed above the 105. But price stayed above that 10 EMA. Never closed below it. It's never closed below it, guys. See that? All the way through. Guys and gals, my apologies. I need to be politically correct. Okay. I don't want to belabor this too much. I think you guys are getting the gist of what I'm doing here to help in setting my targets. And you see that 105 is beautiful. There it is. It's the 38.2. That's going to be first profit taking. That's right in between that mid and that high. If it busted through that, great. The next one's going to be 50. If it busted through that and all my other end, the price is staying above the 10 EMA, I still got a rocketing MACD. I don't have anything crossing over. So MACD will be leading on this thing. So things told me to stay into this trade and not take profit, even though I did take profit. But I left some stingers on the table. All right, I want to go to another setup. CMG. CMG, good old Chipotle Mexican Grill. Seasonal chart, powerful tool that Pete developed. Love this thing. Nobody else has got this. Not a lot of history, guys, on this. You see that little green dot, and it spikes up here in August. Snap that area. This is including 2010. I could get rid of these dates on 2010, but this was a 400% move, and it, boy, I tell you, it rock and rolled. We made a killing on that thing. Again, earnings trade. You can see what it did right there. It just exploded. It just absolutely exploded. And it's kind of meandered sideways here. Now I've got Bollinger Bands set up here. I don't know, Stan, if you talked about Bollingers or not, but Bollingers are very powerful tools as well because they also give an indication of volatility. It's one of the components of Bollingers. When you got them narrow like that, that's when you want to get into a trade. You don't want to get it when they're real wide because you got big volatility. Now, interesting, some things I see happening here. I see a short. Not a real strong rating. Well, it's a 100% move. And I already played this thing up. Where is it at right now? Well, it's sitting way up there. In the 90 and 100% of its historical movement. Where is it at in linear regression? Not really, don't like it here on 6 months. Now, one thing I do notice, guys, is this is the trend. So I'm going to take this bar here and say, show me that. That's the trend. Okay. Sitting up, above the 50. So I'd like to see it up here. I like to trade extremes. If anything, guys, remember, trade at the extremes. Let the trade come to you. Trade at the extremes. But it doesn't mean this thing may not be getting ready to tank, because I got a good historical on it, and it's already exploded. All right, so if I'm looking at this, it's sitting at 66.6. It closed at 149.84. And historically, I expect about how much of a move? Well, on a 14-day best trading a whole zone, about 6.4. What if I change it to 21? 6.4. Got legs to run down a little bit longer. Start date's the same. About 28. It's got legs to run all the way into September. Okay. I like that 21. All right, to make some money and take it off the table. That's 6.4%. Of course, I don't like that 1 and 1 here. But I think this thing is getting set up to tank. I think it's got some legs to run up. I'm going to wait for it to run up and get back to a peak. How's that look? CMG. I have this set at 90-day hourly chart with linear regression set on. And I'm going to take it from its recent low. Now this is Fibonacci retracement. Take it up to its high. Okay. And I did that right here, Fibonacci retracement. Take it from the low, the last low that you see, last high that you see. Just let go. That's all you got to do. It'll figure it all out. change it back to a pointer. I'm going to put my cursor on that, right-click, edit property, because I want to get those exact numbers of that day. I'm going to blow it up a little bit so I can see it. What day did I start? Beginning was 7/20. 7/20, what was that number? Oh, I can't see it. The low was what, 127.30? Okay, I was real close, 127.27. And what was that high right there? High was what, 154.43? Off by 10 cents. And then all I got to do is click OK. But before I do, I want to change this red so you guys can see it better. And click on that magic number. Okay. Hopefully you guys can see that better. All right, what do I historically expect this stock to do? Historically, I expect this stock to go down about 6.4%. Okay? Well, the stock closed on Friday. Again, I'm not saying it's a trade I'm getting into. I'm not telling you guys to trade it. I'm just showing you how to use now. I showed you how to do extension. I want to show you how to use retracement as picking your targets as well. Very powerful tools. I love to use these things. And once you get familiar with them, they're real easy to use. 149.84. No, not 4. 149.84. I was using 7%, I think, as an average that I could expect this thing to tank. So I'm going to multiply that times 0.93 to give me a target, because I'm expecting the stock to go down 7% on average from where it closed. Gives me a target of 139.35, thereabouts. Okay? Well, how does that relate to Fibonacci retracement? Remember, where's the sweet spot that Pete taught us between the 50, the 10% of price movement, right in here, between this mid and the low, someplace in that area. Well, that 139 is right about in between here and here, and it happens to be at 50% retracement. So I know, okay, if I did decide to take this trade, which I don't see any trigger telling me to do it right now, and I'll show you why. Let me add in the rest of the studies. I don't see anything telling me, oh, why is DPO not showing? DPO is above 0. MAC is still up. I still got price above here. It's not ready. If anything, it's got legs to run up a little bit. Great. Let it retrace up to around 154, 155, closer to being overbought, which is where I want to see it here, close to 154, 155. That's going to be more of a trigger for me to say, okay, this thing's ready to start turning around, and I'm going to look for that MAC to cross, get a negative histogram, have this bust below the 0. See, here's Williams R. And guys, remember, I showed you how to put that middle line. I don't have it on this one, so I'll just put it on real quick. Price level. Click, double-click it. Edit properties. Negative 50.000. Set it as a default. yes, good. Now it's right there. Now I can visually see things. Change it back to a pointer. Now I could see, I need this, I could see the percent R's curving down. That's good. DPO's curving down, but nothing tells me to get in yet. But look at that. There's where my retracement levels can be. I know at 38.2, you know what, I'm going to put this over on the right so you guys can see this better. I'm going to put the coefficient on the right side so you can see it better. There. So I know at 30, at about if I traded this and it happened to retrace, and this, all my indicators told me to get in, let's say it was up here, then I know once it gets down to a 38.2, there's going to be some profit taking. That's support. If it busts through that, that becomes resistance. My next one is 140. My next one is 61, so forth and so on, guys. That's what's the beauty of Fibonacci extensions and retracement. Gives you some target prices to shoot for. It allows you to manage your trade more. And watching that DPO, a very powerful indicator. If this thing stays below here and I don't see it pulling up, keeps me in a trade. Again, I'm using an hourly chart. Okay, so that's Fibonacci retracement. Let's look at a couple more. One of the ones that looks promising here is, I don't know much about this company, but came up on my radar list as a seasonal trade. Oops. I don't know why that didn't work. Huh. Okay. And it looked pretty good. Yeah, it looked pretty doggone good. Kind of following the same little pattern here that it does composite-wise. It pops up. Only missed 1 year. Big move, short period of time. Buying cheap out of the money options. Going in with low implied volatility. Small Bollinger Bands. Have everything explode in a quick time. Manage your trade. Have your targets using Fibonacci extension retracement. Know where that stock could go to. Use a DPO to keep you in a trade. I think, Stan, weren't you trading something this week? We were talking about it. I forgot what it was. And I showed you this and allowed you to stay in it longer because you went to a longer time frame. I think it was a 10-day hourly.
Yeah, that was the one I was showing in TAP.
Okay, all right. So you already know
I'm still in that trade after the earnings.
Yeah.
Of course, you know, I've already gotten the earnings pop.
Right.
It bumped up $1.50 or whatever. But the DPO has kept me in it. Normally, I would have sold, you know, with that quick profit. But you showing me that DPO, which why don't you explain what the DPO is, Gary, in terms of taking, you know, the moving average out and so forth, and that
I don't want to get into the minutia right now. You have filled these guys' heads where cup runneth over. I guarantee you. I mean, when you explained to me Vega and volatility, it took me 10 minutes to understand it. So
yeah, I know it did.
If you guys want, just reach out to Stan or me, and then I can give you the mathematics of how that works. And you can actually see it off a profit chart. It works real good. Because I also have DPO on my profit charts as well. I'll show you that, guys, in a second. Again, I don't want to run over. It's already 2:40, so I know the mind can only absorb what the derriere can take. So let me continue. I saw this, came on my radar, looked pretty strong, good historical moves. Well, this is in the industry of gold, isn't it, guys and gals? Go to the futures, and let's take a look at what does gold do this time of year. We got a lot of years of history on this. I see that composite kind of go up. What's it do? Holy Toledo. I got 35 years worth of history, and I got an 80% win probability that gold goes up. Pretty gosh darn good odds, guys. That's the power of our software, is to have that kind of probability stacked in your favor, you know, and then looking at, well, where is gold in linear regression right now? I'm using national data. I don't have dial data, so I'm not caught up, folks. So I could go to my toss charts to see it, but since we don't trade the futures, I just wanted to see what the overall gold market, what does gold normally do this time of year, and it's built in, so you can see, and that just gives you more confidence, or looking at the broad sector, what does gold do this time of the year? Cool. So if you type in Randall Gold, say, oh, okay, same industry, right? Cool. Is it overbought or oversold? Ooh, I like that. 6-month chart tells me it's oversold. That's, of course, 6 month. What about 3 month? Yeah, not so good. 2 month, overbought. 1 month, way overbought. Well, it's picking up this part right here. So I could see the stock's gone 1, 2, 3, 4 times up and down in a 6-month period of time. Good volatility. Spread of about $11 between 84, 95, $11 on a 95 stock. Again, I'd like to see it higher, but it's around 11, 12%. That's good. Now I got a historical great probability. Looking for about a 15.6% move. Stock closed at 92.04. 92.04 times. How much do I expect it to move? I'm normally used to hearing people talk back. Not used to hearing myself talk to myself. 15.6, so times 1.156 gives me my target of 106. Wow, that's really stretching it, isn't it? Guys, that's way out here. It's a big move. What month am I looking at? Gosh, that runs out really past expiration Friday, doesn't it? I'd almost be looking at October buy. Where is it at right now? Hopefully, well, it's kind of down here, kind of popped up. Maybe it'll dip down a little bit and run back up. That's what I'm hoping it to do. Because it's really come down quite a bit. Because, you know, gold has just gone through the roof. It's had a little take back, now it's starting to run up. So, gosh, 106, pretty high. But I'm going to say, all right, well, that's 6 months. What about 1 year? Is 106 a possibility? Well, it's not. What about 2 years? Well, yeah, 2 years, it could definitely go all the way up there. It's really never been there in 2 years, has it? The highest price has ever been is 99. So, but the mid, retracing to the mid of 103 is higher than on a 6-month mid, which is 95, or the 90%, which is that. So, guess we'd look at the option prices for October. That's weird. No bid or ask on this thing. You have to look at September's. Well, September 105s, everybody's loading up with zero volume. One of the things you got to be careful about, make sure you got liquidity and there's buyers in there. There's a lot of open interest contracts. That's great. And, of course, don't forget, right in our option chain is what Stan talked about. We've got implied volatility built right in there. And you could go to iVolatility for free and use their charts to be able to compare it to historical volatility. Boy, that's pretty doggone cheap for a $90 stock. My gosh. I mean, you could literally go at the 95, which is right at mid, right, for $1.35 or $1.45. So what if it goes up $5 or $10? What if it goes up $5 or $10 based on choosing a 95 or 105? Well, you know what? I like to see this number over 300. So if I chose the 100, which I know historically, on average, it could go to 106. So I chose the 100. So, okay, geez, if it only went up $10, Only went up $10. And did it do that historically? Has it gone up $10 historically? It did $14 last year. I don't know what the price of it was, but $635, $675, those are big, strong moves, big moves. I'm looking at 15.6 to 24.16, 28. Did 24 way back in 05. So did 25% at 02. So it's good consistency. So let's look at gold. Hold on. I think I'm running a little bit late here. So I'm getting a warning sign to kind of start trying to wrap things up. So let me try to do that. I think I've already done some Fibonacci's on this. I don't know what time frame I used. I may have used a 6-month daily. Yeah, that's what I used, 6-month daily. You can see where I ran it from the low to the high, down to the last current price of where I could expect the stock potentially to move to. Well, 50% is 106. Can you guys see these or not? So the 105s is between the $102.90 and $106 or the 100s are actually between the 23 and 38. So if it runs up to 102, then I know there's going to be some profit taking there. Now I've got a daily chart. Let's go to something a little bit tighter time frame, 30-day hourly. Maybe we can see it better. Nope. So these would be currently resistance. If they bust through it, it's going to become support. If they bust through that, that support becomes resistance, and so forth and so on. So here's my targets that I'm going to write down. I'm going to trade this thing. I did Chipotle. I just did gold, CRM. Got one more. Overbought or oversold. Price is trending down. Here's a great example of volatility. Big wide bands. What's it do seasonally? Seasonally, it's kind of crazy. Doesn't really, you know, it hasn't really followed its composite and historical average. You know, it is a short, but it didn't do it this year. It was a loser this year. It's gone up. So I really think this thing is getting overbought. And so I was looking at this as well. And there's a beautiful looking chart, guys and gals. You can see where this thing is just overbought. This is basically exactly the same chart, just using it on Thinkorswim that set it at 6-month daily. That's what this is, 6-month daily, showing the same information. The difference is you can't do Fibonacci retracements on this. You can here. It's really simple. As long as your style settings, you have show last price or show high-low price bubble checked. You're going to see that high, low. Simply go to your drawings, Fibonacci retracements, go from the high, click it. Oops, I did it backwards. Go from the low to the high. I think I did that. No, I think I did that right. Guys, I'm getting tired. I can tell you that right now. Let me redo this. Oh, I had it right the first time. There we go. There's the magic number down here. I don't think it's ever going to get down to here, the 1.61. But at 100% retracement from its high, right between the sweet spot and the low spot, could it get down to there? Well, how much do we historically expect this thing to go down? 11.2%. It may be running a little bit late this year by a couple of weeks. If you added a couple of weeks to that date, puts it more like this date. And it's way, way overbought. So my targets on this, someplace between 43 and 40, between 39 and 42 would be here. There it is, 39 and here, right in between, the same thing. But the fibs just give you those accurate numbers. And where this is going to be potentially resistance, if it busts through that as support, same thing here. Let's add in the other studies to see if any triggers are pulling. Well, interesting. I don't know if you guys see what I see, but I see a setup happening. MACD's crossed over, got a collapsing histogram. DPO is coming down, just about ready to cross that zero. Right? Very little to go. Percent R has already busted through the 50. So, yeah, an 11.4% move, 11.2. Take your calculator, take 1 minus 0.112 to give you a 0.888. Take the stock price of 47.74, 47.74 times my target. What's my average target that could it get to? 42. Right in between here. About right in between here and here, 42. So I know that it busts through that, and I should be taking some profit off the table. So again, these are my target prices that I'm going to write down, and I'm going to wait for my trigger, and this is real close. Let's go to a 10-day hourly. Yeah, I see things turning up. You can almost see this thing happening already. Got a crossover MAC. This is busted below. This is busted below. I need a little bit stronger confirmation of the 10 crossing the 20. Now, some of you guys that know me know that I use a 513 as well, a 5 EMA 13. It will give you a little quicker trigger as long as you have some other indicators as a confirmation. I know that some of the other great traders out there use an 8. This is an 820. So this is a little bit quicker than a 1020. An 8 EMA crossing a 20 SMA. So this thing looks real good. And now you've got your targets of what's set up. I want to go over here for the last part a couple of things that I always do, guys, whenever I look at trades. This is a habit you should get into. After you've got your watch list and Best Choice has given you the setup and you've got all your watch list going, one of the things I like to do is get a macro picture. And I love candlesticks and trends. We've got that built in, Best Choice software, which is great. But I also use it on my toss charts as well. One of the things I always do is if I see a setup, like let's go back to CMG as a trade, and I knew this thing was coming up and it was on my radar, let's say, for a big win. And I want to say, well, what is it doing on a macro basis? You know, what's the big picture? I'd always go to profit, and I'd always start with year-to-date daily. And I've set the trend patterns and candlestick patterns on here. You can do that by this icon, button here, and simply click Find Candle Patterns. Click on Patterns, select All, Apply. And it'll find you all the candlestick patterns. And one of the things I saw, of course, this was an earnings-related trade. I knew that. That's an event. That's how Pete taught me. Stocks and consumer reacts to it. But, boy, I saw two major patterns here develop. A piercing pattern and a bullish harami. Two strong on a daily basis patterns that also gave me confidence. So this happened to be before the earnings, though. Piercing pattern. Cool. So then I would go from year-to-date daily to 30-day hourly. Get a little bit tighter. Of course, I saw that same exact pattern, that piercing pattern, right before earnings on the 19th. Saw another one happen here. And, of course, I have my trend line set up here as well. They're all here, guys, under Studies, Edit Studies. Under Studies, you can add all these different indicators. Just go down to the L's and add Linear Regression Variable Channel. Change the length to 60. There it is, Linear Regression Channel. And all you got to do is click Edit Study, change that width of channel to 60. And I, of course, changed the color to yellow. Again, I like to keep my eyes hardwired in the same thing I always do. I always see with Best Choice. Way oversold. What a beautiful setup. And so I'm looking at that on a 30-day, 60-minute, and I'm going to go to a tighter time frame, 10-day, hourly. And of course, I can't go backwards to show you this, but I'm basically using an hourly chart, which is really what you're seeing here on a 30-minute, 60-minute chart. So that's one of the things I'm always going to do is look at the macro picture. First, I'm going to look for some major patterns developing. That, again, will give me confidence. It's one of the things I do. I also have the DPO, percent R, and MACD as well. These are great tools, guys. Learn to use these along with the linear regression, the patterns. Use your fibs. To give you your targets. Write them down so you know there's going to be some profit taking at those, be it in a put position or in a call position. Use the DPO to keep you in a trade longer. Watch it to stay above that 0 Your MACD, you can work all these three indicators in concert, allow you to stay in that trade and manage it, not take off profit too soon, but also to alert you if the trades start to go against you. Like I think Stan alluded to, I think it was this one. Yeah, it's great trade CMR, and we did on a tighter time frame, on a 15-minute chart. You could see prices just bouncing off that 786. So if you're on a tighter time frame, you're saying, do I want to still stay in this trade or not? Then you may want to consider removing yourself from the position if you saw it in a tighter time frame and your MACD started to collapse, your DPO started to fall below 0, as well as your percent R fall below the 50. Okay, folks, it is 3:01 Eastern Standard Time. I can't believe I've just talked for an hour and a half.
You mean only an hour and a half?
Let's see. Oh gosh, I got tons and tons of questions. Let me open it up. I have not been keeping my text box open, guys, right now.
Hey Gary, let's I can save the questions and we can maybe post them in the forum.
Okay. Well,
If we do questions, we'll be here for another hour. I promise.
Q&A. Well, let me field a few. I know there was a bunch I did not address. Anybody that's got some questions on the fib extension, retracements, DPO,
All right,
MACD.
In the meantime, Gary, can you switch control back over to me? Or no, go ahead. Just stay on your chart.
No, that's fine. I'll change it back to you, and then I will just verbally watch the questions or visually watch the questions, and then I'll answer them verbally.
All right, you can detach that little, in the upper right corner above questions, Gary, there's a little arrow thing.
I got it. Yep, I see it.
Then you can expand it out and read the whole
Please
question.
discuss, is this the last one? Please discuss stop loss by, I guess, oh yeah, by Greg. Please discuss stop losses. Okay. Stop losses generally are using in securities and equities. You can use them, of course, in options as well. I have a very, very basic rule of thumb I teach everybody, especially starting out, is at 50% of the premium that you pay for an option, if the trade goes against you, get out. Plain, hard and fast rule. Now, where that comes back to bite some, if you learn this Fibonacci extension retracement when you're in the trade, it's kind of a delicate balance. Sometimes it's more of an art than a science. Sometimes it'll bust through that 50%, and you'll see that happens to bust through one of the Fibonacci extension or retracements, the 382, the 50, the 618, or the 786. And if it's running. And if it busts through your 50% stop loss, then it turns around and runs in your favor, well, now you're second-guessing yourself the next time. You don't want to do that. Stick to a hard and fast rule. Generally, at 50%, I like to cut my losses quickly. I don't. If the trade's not going against me, I want my money off the table. I want my money off the table and say, this one didn't work out, on to the next one. If you cut your losses small and you allow your winners to run, and I've tried to give you some tools today to help you do that, then at the end of the day, your winners are going to be a lot bigger than your losses. Hopefully that answers that question. So stop losses, let's see, can Gary clarify his chart time frames? He seems to switch back and forth a lot, confusing for
Gary?
New traders. Yeah.
Gary,
Yeah.
everyone's going to get a recording of this. So anything that I know that you're so used to using TOS, you went through a lot of those setups really quick.
I apologize. Yeah, guys.
But that's fine because
Yeah,
they're going to get a recording that they can watch as many times as they want. So if we can avoid any questions about, can you show me that setup again, they're going to get a recording of this.
Okay, I'll address it real quick, and Stan is right. I won't belabor it because there are multiple time frames I look at. If you're looking at best choice, you normally are looking at a 6-month linear regression or 3-month. I'll generally do the same thing on my charts, 6-month or 3-month. But there are abilities on charts to look at a 90-day hourly, which is what a 3-month daily is. Same thing. It's just giving me the in-between minutia. It also has the ability to look at a 180-day hourly, which is really just a 6-month daily but broken down on hourly. So I'll look at those two time frames quite heavily. I found the 90-day and the 30-day, if I'm in a shorter-term trade, to be very, very accurate. It's what I used on CRM for the Fibonacci extensions. I hope that answers that question. Any other questions real quick that I can address?
Yeah, can we stop? I'm kidding. I think we need to end it here. If we needed a bathroom break an hour and a half, then we're beyond a bathroom break here. Guys, you'll get a recording of everything, so you know, all the details. Again, it's hard to pack this much information even into 3 hours, and especially when we're each doing an hour and a half. So you know, just review the recording. We'll have that done probably in the next week or so, and those will automatically be mailed to everyone, so you don't have to request it. But you can go back and view it several times. One thing that kind of struck me as Gary was going through, the Fibonacci numbers, guys, are awesome tools, and anything you can learn on Fibonacci, I would encourage you to do that. But one of the things that struck me as Gary was going through everything is how really accurate Best Choice is, and the way Pete has set up like those 3-line charts. When you look at some more detailed indicators like Fibonacci, it's amazing how Pete came up with simple charts that really show you the same information. I mean, those turnaround points, I think you were telling me, Gary, more often than not, almost hit exactly our extreme lines on the 3-line chart.
Yeah, they
Fibonacci turnarounds. So anyway, guys, what we tried to do today is just give you a little more details on how to enter, exit, and manage your trades. I hope that the information that we gave you was helpful. Let us know. Give us our feedback. Also, let us know, you know, maybe some general things you would like us to cover in some future advanced trainings. Again, any basic stuff, get with the office, find out who your coach is, and schedule an appointment with them to go through the basic training, because that is critical. That's the starting point. And most everything we've done today assumes that you already know the basics of using Best Choice. But we wouldn't be doing anything that we did today without Best Choice. Best Choice, as Gary said, is our setup tool. It tells us which ones to be using these other tools on. So, Gary, unless you have anything else, I think we should wrap it up.
No, I'm all set. Everybody, thank you for giving us the time this afternoon and allowing us to share your Saturday afternoon and share some of our trading knowledge with you. Again, as Stan said, I hope it's helpful, beneficial. We're here to help. If you got questions, just shoot us emails. I'd really love to hear from all you guys feedback, what you thought today, as well as, you know, not a long dissertation, folks, but, you know, what would you like to see in the next one Stan and I do? What can we do to help you guys be more successful traders? Now, Stan and I make money with this. We've taught a lot of people to do it. There's no reason anybody else can't with the proper training. So shoot us something and say, hey, I'd like to learn about this or I'd like to learn about that. We can kind of compile it, synergize it, and the next one that we do, we'll be glad to focus in and address those things to help you guys. So that's all I got to say. Thank you very, very much for all you guys' time.
All right, and I would like to just say one more time, if any of you are kind of beyond even what we've been teaching today, you're into more complicated option strategies, please get hold of Scott at the office because he can help you fine-tune those complicated strategies where Gary and I, you know, are kind of just the basic Best Choice traders, but Scott really has that expertise that you can tap, and that's a resource you should use. All right, guys. Well, I'm going to wrap it up. We're only 10 minutes over.
One more thing. We got a quick question that asks, what is the email to give the feedback to? One of two, either Stan J, S-T-A-N-J, at bestchoicesoftware.com, or Gary H, G-A-R-Y-H, at bestchoicesoftware.com.
Yeah, it's just our first name and last initial at bestchoicesoftware.com. Either one of us, We appreciate your feedback and suggestions, and maybe if you can't think of something specific you would like us to talk about in the future, maybe just some problem you're having with your trading. I seem to be doing everything with Best Choice, but I'm still losing money. What's happening? Just get in touch with us. That's what we're here for, guys. We're Best Choice coaches, and we're here to coach. So, all right, I'm going to wrap it up and get this recording started. We will have that disc out to everyone probably in about a week, and hope everyone has a good rest of the day.
Take care, everybody. Good trading.